Welcome back to Boring Currency, where we track physical metals, paper market stress, and the forces reshaping the global financial system. 2:30 p.m. Monday, February 9th, 2026. Fix your eyes on the number on your screen. 79.50 towers. Just 48 hours ago, on that brutal Friday, February 6th, silver was violently smashed down to $64. They wanted you convinced the market was finished. They wanted fear. They wanted panic. They wanted you dumping everything you owned. But look at what is unfolding right now. Silver is not dead. It is clawing its way back from the grave like something unstoppable. We are already up 3.14% as Asian markets opened. Do you recognize this pattern? This is not natural price action. This is a crime scene. What happened was a robbery, a textbook bear trap. On Friday, the rules were suddenly changed to trigger margin calls. Stop losses were hunted down. Forced liquidations shoved holders out at $64. And now, this morning, they are smiling as they sell the same silver back to you near $80. If you panicked and sold on Friday, I truly feel for you, because you were played. You sold the exact bottom. But if you held firm, if you kept diamond hands, look at this V-shaped rebound. This is a direct slap to every short seller involved. But ask yourself this: why? Why is price ripping higher so fast when headlines were screaming disaster? Because there is more to this story. And do not look away now, because I'm about to take you back to Sunday to show you exactly where the silver actually went. Let's rewind. Close your eyes and imagine yesterday, Sunday, February 8th, New York City. While the world stared at screens, while online commentators declared silver finished, while paper traders melted down over a waterfall chart, something very different was happening in reality. I'm talking about ground level, the trenches, a small bullion shop in the heart of the city. Nothing flashy, glass cases, faded posters, a door chime with character. Inside, chaos. The dealer, a veteran who has seen everything, stood there with cold coffee and a receipt he never requested, just trying to survive the onslaught. The shop wasn't just busy. It was overwhelmed. Buyers packed in tight. The atmosphere felt like a pressure cooker. Here's the puzzle. The screen price was collapsing. Silver was down. Gold was down. Red everywhere. So why were people lining up to buy? Because they understood something algorithms never will. They knew the screen price was fiction. One buyer pushed through and asked what everyone was thinking. Is this a good time to buy silver now that the gold-silver ratio spiked again? Before the dealer could respond, another customer jumped in like a group chat whisper, "Paper merchants, paper merchants." That was the mood. Suspicion, excitement, anxiety. Phones in hand. Refresh, refresh, refresh. Trying to force the price to behave. The dealer locked eyes and delivered the truth. The premium is way too high. Not slightly elevated, not mildly expensive. Way too high. Wall Street doesn't grasp this. When silver whips around violently, you don't buy at spot. You buy spot plus stress, spot plus logistics, spot plus the risk the dealer can't restock tomorrow. Think umbrellas in a storm. Rain doesn't make them cheaper. It makes them scarce. Premiums rise. That's exactly what happened. Customers asked for American silver eagles. Gone. Orders delayed. Tubes of maple leafs. The dealer admitted he was sourcing them from other customers walking in. Read that again. Not wholesalers, not fresh supply. Walk-ins rearranging stacks. The pipeline was broken. Inventory vanished. Paper markets screamed worthless. Physical markets said priceless. It was emotional, awkward, stressful. People were upset prices fell, and thrilled they fell. Same screen, different mindset. Then one calm voice cut through. A seasoned stacker, decades in the game. Watching panic, he shrugged. Doesn't bother me. I'm long-term. Then he silenced the room. I've never sold an ounce. No trust in paper money, no dollars, no yen. This isn't a flip. This isn't a trade. It's a philosophy. He looked around and said, "For me, metal isn't an investment. It's legacy." That moment shifted everything. We're not here for green candles. We're here because the system is broken. When debt clocks scream $40 trillion promises collapse. That dealer struggled to quote prices. That total? Pause. Look at screen. Hold on, that's wrong, it's higher. Prices changed minute to minute. and customers laughed and bought anyway. Because stacking isn't timing perfection, it's accumulation over time. So if you're staring at $80 today, wondering if you missed it, understand yesterday. Smart money didn't sell. Veterans didn't sell. They bought everything. They drained the physical supply. That's why price is erupting now. Paper shorts crashed the market and ran straight into a wall of physical demand. Vaults are empty. And don't go anywhere, because if local shops looked bad, wait until you see Comex numbers. You've seen retail panic, heard veteran resolve. Some still dismiss it as noise. Just Brooklyn coin shops, they say. Institutions have metal. No. Retail shortages aren't glitches. They're smoke from a burning building. And now I'm showing you the fire. March matters. It's delivery month. Paper becomes metal. And the math is terrifying. Open interest demands 380 million ounces. Let that sink in. That's the bill due. Available metal? Only 105 million ounces. They owe 380. They have 105. Nearly a 300 million ounce hole. Musical chairs with one seat. Yes, skeptics say most contracts roll. Normally true. But this is a credit crisis. Trust is evaporating. Even 15-20% delivery drains 57 to 76 million ounces. That leaves vaults nearly stripped. Banks know this. That's why they hype gold dips and stay quiet on silver. Every physical ounce bought worsens their short exposure. Friday's crash wasn't macro. It was desperation. A liquidation trap before March. They needed fear. They needed exits. Instead, buyers stepped in. Asia opened. Price ripped back to $80. Margin nuke deployed and absorbed. Now they're trapped. Rising price, empty vaults, customers demanding metal. This is how squeezes form. Slowly, then suddenly. IOUs mean nothing in a credit crisis. Industry doesn't care about charts. Solar, EVs, tech need silver. They will panic secure supply. That's why premiums exploded. That's why recovery was violent. The emperor has no clothes. 380 million demanded versus 105 million available is a ticking bomb. That green candle isn't just recovery. It's realization. Shorts trapped. Real move beginning. $92 and beyond. If you held, breathe. You survived a financial war zone. Friday wasn't a dip. It was a stress test. Most failed. Weak hands sold. Diamond hands didn't flinch. Now we look ahead. 79.50 TAUs. $15 recovered in under 48 hours. Sellers exhausted. Momentum shifting. $64 was the trap. $80 reclaimed. Next stop, $92. Soon. Vaults are empty. Math is brutal. You can't print silver. March is collision month. But expect volatility. They'll try again. Swings will be violent. Remember the lesson? When spot drops, real price rises. You aren't holding a lottery ticket. You're holding the backbone of the future. Silver powers solar, EVs, electronics, and supply is disappearing. When Comex runs dry, price discovery changes forever. This is supply and demand in real time. Credit cracks are spreading, systems wobble, central banks know it. That's why they hoard metal. So here's the verdict. The bear trap snapped and caught bears. $64 was bottom. Now we aim higher. But decide now. Your horizon, your strategy, your protection. Because that green candle at $80, that's the door closing. For doubters, opportunity fading. For stackers, victory. Stay disciplined. Ignore noise. Focus on ounces. An ounce is an ounce. They tried to break you and failed. Now we take control. We